Hello, Anthony.
Hello, Claudia.
Today we are beginning a wonderful series about C-corps.
That's right.
And we want to touch on some basic benefits and maybe not so good things about C-corps.
Right, and I think that we need to first point out these are C-corps as in the letter C, not as in the ocean C,
yes,
right? That
yes.
People might be confused.
So a C corporation is any corporation that's taxed separately from its owners. It's legally viewed as an individual entity.
And C-corp determination is not a feature of corporate law. Okay, C corporations is something invented by the IRS. Okay, so you don't go to your Secretary of State to say, I want to file a C corp. Your corporation and actually other entities can elect to be treated as a C corp.
Yes.
Or they will be by default treated as a C corp, and you have to elect something else if you don't want that.
Okay, so let's talk about the good things first. Okay, if you need a lot of startup or expansion capital, it's easier to raise because you have stocks to sell.
Right, and that's important because you don't have to dip into your cash flow.
Right.
That basically they're stockholders, and so they're gonna they'll profit when the company has its big payday.
Yep. No shareholder limit, but once the corporation has 500 shareholders and 10 million in assets, it's required to register with the SEC. But
Right.
there's a but here.
Right. So there's no so with a C corp, there is no shareholder limit. That is the IRS. That's the IRS law, right? But your corporation may have a limit to how many shareholders is, in particular, if it's a closed corporation. So that's just something that you have to always remember, that you have two different laws you're dealing with: the tax code and then the corporate code of whatever state you have, or foreign country
Yep.
you have incorporated this in.
And we will get more into depth in the benefits of different states
That's
as,
right.
as
Yep.
the series continues. Now, if you intend to eventually take the company public, it must be a C Corp or it can be an LLC to be traded on a national exchange.
Right. It has to be a C corp, but it doesn't have to be a corporation. No, does that make sense?
Yeah. Well,
It could actually be an LLC
yes.
that elects to be treated as a C corp.
Yeah. And that's Form
8832, I'm going to think.
I think. We will verify
Yes,
that.
we'll verify.
Okay, so another good thing is limited liability. This applies to the directors, shareholders, officers, and employees. This is, again, something that varies by state that we'll talk about: Delaware, Nevada, Wyoming,
right.
as the series continues. But it's good. I mean, if the corporation sued, shareholders are only liable to the extent that they invested in the corporation.
And it's also true for S-corps,
Yep.
the other type that we'll talk about later. And also true for LLC. The limited liability
Yes.
applies. Also for limited liability partnerships, and limited liability limited partnerships
Yeah.
exist in some entities.
This way, your assets aren't
Right.
on the line.
So it's not anything unique to a C corp, but it's something that is a huge benefit. And by the way, it is Form 8832.
Oh,
we
we're
were right.
good.
Yeah.
Any debts the corporation has are viewed as the corporation's responsibilities. And what I found is a lot of small companies opt to incorporate to protect themselves instead of getting expensive insurance. So it's sort of an option there.
Right. And that would be that. Remember my awesome tax proposal? If we got rid of, if we made the taxes a little lower, and if we made it so that, hey, look, if you want to have limited liability, then the IRS is free to tax your income because your corporate entity is a fiction of the state. If it's a fiction of the state of the government, well, then they have the right to go inside your books. And I think it's a fair trade-off. If, on the other hand, you want the government out of your books, well, then you can't claim that limited liability. So what you would want to do is insure against possible lawsuits.
Got it. Now, a big thing with C corporations, S corporations are the taxes.
Oh, yeah.
And we'll start with the benefits and then maybe talk about some of the drawbacks. The cost of fringe benefits is deductible by the corporation, not considered taxable income to the employee. So the more fringe benefits you have, the better. So that's something to consider. To be eligible for a tax break, a large portion of the employees, usually about 70%, must be able to take advantage of the benefits. So for a lot of small businesses, the expense is too expensive to be an advantage. They can't afford to do that.
And I don't know if I'm going to jump ahead, but do we have this as one of the big advantages of a C corp? Is you're allowed to give stock options,
Right.
Which is critical when you're a growing company. If you're a startup, first of all, your venture capitalists. If you're looking for an IPO, there's very few IPOs going on, but more if you're looking for be a target of an acquisition. If you're not offering stock options, you got a problem. because they're going to look at, well, your employee retention probably isn't all that great. This is I would say one of the most important things of going with the C-corp is that you can now offer those benefits. With an S-corp, you can't, because really everything's passing through to whoever the shareholders at. That doesn't work with a company with many employees.
Exactly. Now, when we talk about the drawbacks, there's a big drawback.
Oh, it's huge. It's the biggest one there. It's the number one drawback is that you have the possibility for double taxation.
Yes.
And that the corporate tax rates for the U.S. tax rates for C-corps are the highest in the world. And it's sort of the brackets, they just call them surcharges, but it's one of the most interesting ways that they have. Now, your first $50,000, right, is taxed at 15%. But things jump up significantly. We go to 25%, and then we go to 35%, and then we go to it keeps growing here. And I gotta hang on one second here.
So the more money you make, the
more money you
taxed.
make, right? So the first 0 to 50,000 is 15. 50 to 75, 25, 75 to 100,000, 34. 100,000 to 335, 39. I mean, these are just incredible jumps.
Yeah.
And I'm sorry, but a corporation making all that, that's not a lot of money to say, hey, we gotta go after these rich corporate abuses.
Yeah.
Are you kidding me?
Yeah.
The guy, they made $75,000, and so you're going to hit them with $34,000. Then it goes up again to when the 100,000 to 335,000 to 39%.
Not 39.6?
Yeah, right. It's not the 39.6, our favorite highest ordinary rate. But then it drops down when 335,000 to $10,000. Of course, your total tax liability is higher. And then it goes a little bit up for 10,000 to 15,000 to 35. And then for over 15,000 or 15,000 to 18 or 15 million to 18 million, 38. And then over 18,334, and these do typically adjust for inflation, 35%. So you can see there's a few places there where it really stinks. And now that is the corporations have to pay taxes on that, right? So these are really high rates. Mm-hmm. Now there's no self-employment taxes in there too. The corporation is deducting the employment taxes from their profits, even though they're paying them. Mm-hmm. They are paying them, or they should be.
Yep.
So these are really, really high rates to begin with. So, this is the thing you have to decide. And plus, we're not done yet. Because if the IRS, this is what you're taxed on, whether or not you make a dividend, distribute it to anybody.
Yep.
Corporation sits on it. So what? You're paying it. We don't care. And you're allowed some working capital that they won't tax you on. But if they feel that you're holding on to too much money, they're going to hit you with an accumulated earnings surtax of an additional 3.8 or 3.9, something like that.
And that's at their discretion? There's no
somewhat
percentage?
At their discretion. It's not a percentage. It's, well, you don't need this much, because it's going to vary from business to business. Businesses with high seasonality, you can probably get away with more working capital.
Yep.
Businesses are growing too. But something that's a business that's pretty much the same thing in and out. Hey, look, we know you need this much to meet your next, to keep your cash flow going. So that's really the thing you have to watch out for. Then now you have to. Then when you make a dividend dividend payment to a stockholder, oh boy, now they're going to be taxed at the 15% or 20%, depending what bracket they're in. So you could see whoa. We're paying 60% tax rates, and this is just federal, because the states, depending on what state you're in, they're going to want something too.
Right.
So this is just crazy when you think about, oh my God, how much money does a corporation have to make to be profitable to overcome this crazy tax system? So one thing you could do is make a crazy profitable corporation, or it's just easier to find some tax strategies so that you avoid this. And there's a lot. We'll be talking about those in an upcoming series, because there's a lot of things you can do, and it is one of the most interesting sort of challenges. It's a chess game. There's a lot of moving pieces.
And the IRS does know about a couple of the tricks. Some corporations pay all their shareholder employees higher salaries, as opposed to distributing income as dividends.
Right.
But the IRS looks and goes, wait a second.
Yeah, and that's not even a great loophole, really,
No.
because essentially all you're doing is taking a tax treatment that's worse than if you were an S corporation. An S corporation, all that money will flow through. You could give it all to your shareholders,
Yep.
And the shareholders will pay the ordinary taxes, but they don't have to pay on the dividends. They don't have to pay self-employment taxes. So a little bit of savings on that.
Yep.
So even that isn't. That's not like, okay, because they really could be paying a 39.6% effective rate on that bonus plus their state taxes. So, okay, so we went from 60 effective to 50, right? Is that really worth it? Wow, what a great deal.
Yeah. And then, if you're thinking about starting a C Corp, I would say another drawback besides the double taxation, just confusing. There's a lot of legalities. It can be expensive, more expensive to start a C Corp than an LLC. It's something where you would want to consider maybe hiring help.
Yeah, and you have to say, okay, you're going to be a corporation. If you're going to own it yourself and not really have the shareholders, it's really going to be your alter ego. You have to understand, you have to go through the corporate formalities. I remember my dad we were working on some case, and the person had, I think, a medical practice, and it was a corporation. And my dad asked for the meeting minutes. And it was this is a corporation. It was all owned by the doctor. Why would I do that? Well, you have to keep your meeting minutes, but it's just me. Okay, but you still have to put down, like you had, we had our shareholders meeting. We declared this. We did this, this, and this. So, and if you don't, then basically what could happen if you're sued, they could say, well, this isn't really a corporation because you're not treating it like a corporation. That's the whole issue. When you don't treat something like a corporation, that limited liability, you're going to lose. And the IRS can also say you're not doing it. So if you don't go through what's required, you're really not doing much of anything. That's why the LLC is much, much simpler. You don't really, no one's going to give you that hard of a hard time.
Yep.
Even though you do have your meetings, it is a lot easier. So that's something to think about. Are you really somebody who's going to, sit down, write down and say, oh yeah, we had our meeting of the minutes. We all were present. Yeah,
I was looking at one of the IRS documents about C Corps, and it was like 28 pages, and a lot of it was covering the very specific record keeping requirements, exactly what you have to keep, how long you have to keep it. You have a requirement to hold a formal board and shareholder meeting and keep accurate minutes of the meetings. A lot of tax forms to fill out, often requiring an accountant. These aren't things you're really doing on your own. And then C Corps, the government sort of pays more attention to them because there's so many specific tax laws. So be ready to be under a microscope, unless you do things correctly.
Well, you're also going to be under a microscope. So that's the incentive. I mean, I think no matter what, you're going to be under. So this is not the area where you want to just sort of slap something together. You can get away with a lot of things. I mean, the truth is you can get away with a lot of things.
Until you don't.
Until you don't. But when when you are filing Form 1120 as a C Corp, you are in the same, you're starting to become the same sort of big boy as a multinational corporation. And they're going to say, well, you're a corporation. You should know all of these and you should have your professional. So, the standard that you're going to be examined under is going to be higher. So just be aware of that.
Yep. All right. So if you have questions or comments, you can like and comment below. And you can subscribe to our channel to get more awesome tax updates, tax strategies for C Corps and S Corps. And thanks for watching. IRSMedic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.